this is a ongoing work today that I'm sharing with you from the start. It's not a written paper as such. It is a way of exciting minds and getting minds to work on some of the pressing problems of the day. I can see we have, key researchers here who are working on some of the issues. We also have policymakers who may wish to pick up on some of the policy challenges. And so this is a kind of a discovery discourse, this kind of a conversation that we're starting. It's joint work with the Athina, Petropoulou, who until the end of last month was a postdoc research fellow here in the Center for Global Finance, SOAS, University of London. But through the involvement in the Center for Global Finance, her share price has gone up, and also has her market value also increased. And she's now a lecturer in finance at the University of Sussex Business School, University of Sussex, next to Anna here. Okay, and I should also acknowledge a number of people here in the audience who have contributed to a lot of the ideas that are being discussed. For example, the discussion will feature some of the ongoing work with Yusuf Somare from Ravar University, who is here in the audience, and also Francois Botiano, who is also was a PhD student of Yusuf Somare, but is now working in Quebec. It also draws some of the work that I did previously with the Chris Green at Loughborough and Ahmed Hassan Ahmed at Loughborough, and also a lot of some of the work on FinTech that is being developed with the colleagues at the University of Essex as part of the research on a UK-India bilateral trade in FinTech and FinTech-related services. So there is a lot of intellectual debt in some of the ideas being discussed here. And right at the end, in the conclusion, when we are talking about the building blocks, I would like to acknowledge the work with the Sandra Kablin, Sandrine Kablan at the University of Paris, together with Athina and myself. We are looking at natural resources. And also the work with the Athina and Eric Jardine at Aix-Marseille University on testing synthetic currency for the East African region. Okay, so this work is provoked, and again, I want to thank here Dr. Danny Kariaria, the governor of the Bank of Zambia, the central bank, and also the chair of the Association of African Central Banks, because this work was initially presented as a keynote when the central bank governors from Africa were meeting as part of the annual Association of African Central Banks meeting in Livingstone. There's, of course, since then, there's been a number of changes, and also given the comments they provided, some of these narratives have changed. And so we acknowledge the benefit of having been in that seminar. The big question is that actually African central banks are in a state of uncertainty, given a lot of developments from the COVID-19 lockdown, from the later shocks also, including geopolitical shocks, but mainly because of advances in financial technology. Now, for these shocks, the question is, how can central banks in Africa enhance resilience of their economies in the face of these global shocks? And that question is taking on increasing dimension, increasing important dimensions because of the dynamics in the global financial landscape. And this is why it becomes an urgent issue, what it becomes a conversation. So in this presentation and this discussion, we'll just go through a number of things, but 5 main elements. And I may have to skip some of the slides, but mainly these are the 5 main elements. The first one is to highlight the external shocks on African economies. Name some of the shocks, the timeline in which they have occurred during the last 25 years, the nature or the DNA of these shocks, the data is and the data available. But looking at the shocks, we need to fall back on economic theory and finance theory, especially the theoretical underpinnings of central banking. What do we know, and how can these theoretical underpinnings help us to understand, interpret, and manage these shocks? In particular, 2 questions. The first question is, how are global credit market shocks transmitted to financial systems in African economies? And this is mainly drawing from the work with Issouf Somare and Francois Boutiano. And also the second question, how can specific macroprudential regulations be tailored to enhance resilience of African economies in the face of global credit shocks? And I will also be covering a work of how economies globally and how economies in Africa have reacted to some of these shocks, especially the recent shocks arising from the COVID-19. And finally, conclusion will be to talk about the way forward for central banks. They may implement macroprudential regulations, but that is part of the response. The bigger response would be how the central banks can redesign the architecture of financial resilience and lead in the design architecture of financial resilience in African economies. And that's a tall order, a big agenda. But I will focus only on about 5 to 6 building blocks. Building blocks in the sense that they have to be in place for any new architecture of financial resilience to be able to function. And that's the key arguments that we shall conclude. And maybe from that conclusion, be able to think about, a research that can guide this direction. The discussion is heavily tilted towards financial regulation, but with a little bit of monetary policy issues, because these monetary policy issues are covered almost everywhere since the COVID-19 lockdown. Okay. The shocks, the external shocks on African economies. Now here we feature 25-year timeline, including the shocks that were not really exclusively targeting Africa, but in fact, a common element among all this for the last 25 years is that these shocks were global in nature, but heavily impacted on African economies. And that's why we are looking at some of these shocks, which have been happening, say, since the Asian financial crisis, way back in 1997. Then the global financial crisis 10 years later, the food and oil crisis from the supply side, the geopolitics on the Arab Spring a year later. Again, then you have about 5 years later, the oil price collapse in 2014. You have a little bit of pandemics, like the Ebola outbreak in 2014, actually hitting very badly West Africa, but the entire continent. And then, of course, the big elephant in the room, the COVID-19 pandemic, in 2020, and now you go into the current ongoing force, the geopolitics coming from the Ukraine, Russian war. And so you see these external shocks, the kind of a timeline that they tend to be dynamic and continuous. And maybe even in terms of the dynamics, the pressure that did arise from the Asian financial crisis 25 years ago is a continuing process. So we need to be able to understand the nature of these shocks. Okay. And this is a part of an ongoing paper that I'm working on, which is about the DNA of a financial crisis. It builds on my previous work in which I'm trying to pin down the crisis in Africa, a regulatory response from a previous book entitled Bank Regulatory Reforms in Africa. It came out about 2011, 2012. Okay. And the argument here is that the ever-shifting global financial systems generate financial crisis. But what is it that drives the crisis? And we argue it's a double coincidence of two aspects. The coexistence of market failure, that is when markets are unable to price risk, together with regulatory failure, when regulators also fail, because regulatory responses are supposed to correct for market failure. But when market failure coexists with regulatory failure, then a financial crisis happens, and almost inevitably happens. And this argument of the coexistence is actually visible and documented in all the crises, and that's why it features like DNA. It features as an integral component of the crisis, going back from the Tequila crisis, which was a currency crisis with the collapse of the Mexican peso, that then in 1994 ignited capital flight. But also this same double coincidence is eminent in the Asian financial crisis of 1997. And when you see exchange rates collapsing and also stock prices collapsing, these are prices both for equity trading and also for foreign exchange trading. And the two they collapse one after the other. And there is the market failure. Regulators couldn't respond in time, and actually failed to respond until the intervention of the global regulatory forces. But if you follow then a year later, the Russian financial crisis hit Russia on August 1998, and you have the collapse of the ruble as central banks devalue the currency and defaulted on the debt. And again, market failure, regulatory failure coexisting. The global financial crisis were documented and does indeed bear symptoms of the double coincidence. The Eurozone crisis, a sovereign debt crisis in 2009, involving a number of European countries, and here you find they cannot find their debt. They can't refinance their debt and then bail out of indebtedness. As again, here is an ongoing paper with the Sami and Sajid on European bailouts. And again, that crisis gives a market failure and regulatory failure in the sense that the bailouts were not spontaneous, were not instantaneous. They come later, aware after the crisis has devastated the economies. And again, final, of course, the post-COVID multiple shocks and the big squeeze as IMF has documented in their quarterly report in April this year, is also part of the double coincidence of the market failure and regulatory failure. So that's the story, the narrative that goes through, what we know if we take a close look at the crisis in the last 25 years. Now, when we look very hard into the recent external shocks in African economies, what can we read from the data? Okay. And one can watch a number of key indicators, key economic indicators, like foreign exchange reserves. What is happening with foreign exchange reserves? What is happening to import cover when some central banks can hardly have or portray import cover for even 3 months, the shortest period for import cover, signifying stability in foreign exchange reserves. What about the exports from Africa and the way it impacts on the trade balance? What about in terms of FDI, in terms of all flows, including remittances here have been hit? And also the data shows the oil price collapse. The terms of trade deteriorating. And of course, one gets exceptionally close insight, maybe a little bit scary when one looks at the balance sheets of a number of central banks. So yes, the evolution of the key economic indicators is where you actually come to see the picture and say that the things are far from being normal. And just to highlight just a couple of these, rather than cover all the 54 member countries, the 54 countries on the continent. If you look in terms of the foreign exchange reserves, say take a kind of, a Nigeria law goes high in 2018, and then we have a constant decline. And then you have also the reserves, though, declining in Angola, not so much in terms of South Africa, and with Egypt only just collapsing in 2020. But the Angola one is, again, kind of very scary. And you get a number of countries in this scenario where total foreign exchange reserves have been hit. But you see, the crux, the big issue about foreign exchange reserves is whether the country or the central bank can maintain enough foreign exchange reserves to be able to cover for essential inputs. And one of the dimensions cover central banks is the import cover. And so what is interesting to see how the decline in foreign exchange reserves is affecting the import cover. This is a computation of import cover from IMF data. And we see the import cover for, say, from Angola declining from 11 months to 6 months, Egypt 5 months, 3 months, Morocco 9 months to 5 months, Seychelles 5 months, 3 months, South Africa 8 months to 5 months, Tunisia to 3 months in just a space of 2 years. Okay, so that's a little bit of worry. And we do this. We've done this for about more than 50 countries, and we have extreme variations in this, and hence the reason for this. Now, of course, the question here, the relevant question here for researchers out there, we were just working on this, is to look at issues of liquidity, short-run liquidity. Yeah, the short-run liquidity provisions, especially for central banks, and how this can be redeemed. Another key indicators I mentioned in the passing is in the introduction, the demand for African exports, and here we have, say, in the blue, all the oil exporting countries, say, stable, decline over time. And then you have sub-Saharan Africa, which is this line. Again, you find a decline. And then, of course, oil importing countries, a bigger decline. But the impact here is that even for African exports, which are not agriculture exports, but oil for oil exporting countries, in percentage of DP, in the percentage of GDP, the decline is showing. And even when you give projections after 2020, there are kind of increase for 2020, but 2024 is declining. The same story gets in terms of the trade balance, comparing exports and imports. The oil price collapse, again, we have here the scenarios following a global financial crisis, which is around this time, around this period, but also, again, a global financial crisis, the COVID-19 shock around this period. A little bit of rise 2022, but then decline into 2023. In terms of the oil price collapse and terms of trade, especially looking for the period 2014-2016, and of course also 2020-2023. This shows the period of a decline in oil prices significantly that impacted on Africa's oil exporting countries, especially Nigeria and Angola, countries that normally would be awash with the liquidity from the oil reserve, but not, which has led to decline in revenue shortfalls and created some economic challenges. In terms of FDI, you find again the data indicating that some of the global financial crisis and some of the crises we saw on the 25-year horizon have translated into a sharp fall in foreign direct investment. And actually, I should point out here that even when this data is disaggregated to highlight the various types of investment flows or foreign financial flows, you say this impact is phenomenal. In terms of the fact that these key economic indicators finally find their way in terms of the flow of funds to the way government finance operates in terms of the government budgets, government spending, and government revenue, and comparing both the government revenue and government spending, the fiscal balance. And what we see here is for the entire sub-Saharan Africa, whether oil exporting countries and oil importing countries, the fiscal balance has deteriorated. This is the fiscal balance, including grants, including flows that governments receive on the grant element without repayment. As a percentage of GDP, the fiscal balance has been deteriorating. In other words, governments find themselves in a position when they are unable to increasingly meet expenditures, when they are finding difficulty to balance the budget or to meet expected expenditures because of declining in revenue and declining in the fiscal space. Okay. Increasingly, when revenues shrink, the fiscal balance declines, then governments have to borrow from abroad. Okay. And governments may borrow domestic, they may also borrow abroad. Whether they do so, both of them, that's a composition of government debt. And what we note here in this chart is actually over time since, say, 2005, government debt as a percentage of GDP has been increasing. And that's where you look at the whole Sub-Saharan Africa in this line, whether you look at oil exporting countries in here, whether you look at oil importing countries. It seems to be kind of like a worrying government indebtedness. There is, of course, another literature which the Center for Global Finance Group pursued by Hongbo, Rodia Trawar and others, that shows the contribution, and of course, Catherine, the contribution of indebtedness to China on Africa and how this is, changing the narrative. But in general, we have the fact that government debt is increasing. Now, as I did mention at the start, this is a period of a high liquidity squeeze on African countries, but also the fact that central banks all over the world, and you can see the news almost on a daily basis around the world, the news reporting hikes in interest rates, and hikes in interest rates responding to high inflation. So as inflation remains high, central banks are provoked, or they do respond by raising interest rates. So we are in a period of coming from zero interest rates globally to higher global interest rates. Okay. And Africa is no exception. African central banks have also responded by hiking their policy rates. Here we take a caption of these that have the hikes in interest rates. And here in the bracket is the percentage hike in the interest rates by changing the central bank policy rate. Okay. Botswana, Mauritius, Eswatini, Rwanda, Namibia, Gambia, highest, Ghana, up to about almost 30%. These are the hikes that have appeared. I think the only exception here we find is Angola. But the rest of these countries share that all these central banks have indeed responded to higher inflation rates, increasing inflation rates, because of the collapse of the supply side, liquidity squeeze, and the policy change of raising the interest rates. But of course, the liquidity squeeze has also translated into higher external borrowing costs for Africa. The cost for borrowing for many African countries has always been higher than the average, has always been higher than the London Interbank offered rate because of the markup that is imposed on borrowing by these countries. So the argument here is that the sovereign spreads, indicating on the borrowing by governments, have gone up and now represent almost a 20-year high for African countries. And how has this impacted on the national currencies in Africa, especially national currencies against the US dollar, say last year? And what you see here is the depreciation, the fact that most currencies in Africa are depreciating against the US dollar amid high inflation, the weakening of the currency relative to the US dollar, and also this contributing to increase in debt, and of course, spiral resulting also in further exchange rate pressures and further depletion in foreign reserves. Now, this just cutting from the map of sub-Saharan Africa, excluding North Africa. Here, this captures the exchange rate depreciation, the intensity of the exchange rate depreciation against the US dollar in 2022. And these dark patches here, you can see here, Ghana and other countries, here, this is where the intensive depreciation has been. And with the less here up to some of these countries. But the general picture overall is showing, very serious depreciation of the national currencies against the US dollar. And this is why in the building blocks that we put forward toward the end of the paper, you will see one building block being the question of the how to reform national currencies, and how we can design the currency as part of the building blocks. Okay, this is a summary of how some central banks have responded to COVID-19 pandemic, the recent shock. And this is taken from the Bank for International Settlement last year. Is cast the whole framework is comparing Africa, emerging Asia, Latin America, and the rest of the emerging markets. In particular, trying to see two types of responses. A response in the policy rate, central bank policy rate, the interest rate by central banks that impacts other rates in the economy. That is one type of response. Yeah, you could refer to this as actually a monetary policy response. Then how this is impacting central bank balance sheets. Okay. And so here is a snapshot of how African countries, taken as a block, compared to emerging Asia, Latin America, and the rest of the emerging economies during this period. And you see that in terms of the policy rate changes, this more or less has been to actions that are restricted to the foreign exchange liquidity, but also looking at targeted lending that are in the economies. The other monetary policy actions have not been invoked, as you can see. Definitely no policy rate cut. A reserve requirement cut that hasn't happened so much in many economies, and loosening of regulation has not happened. In terms of the central bank balance sheets, you see that really the contraction in Africa on about less than 34% as percentage of total assets, compared to what's happened in the other emerging countries, whereby basically you have a rise to almost 48%. Okay. So if we look outside Africa for purposes of a comparison, we see quite a number of responses by central banks. First of all, that major economies in the world, including US and UK, responded almost by QE, quantitative easing. This basically involves large-scale purchases of assets, and then forward guidance, increased communication about central bank's outlook. But also research has suggested that other tools have been used, especially for funding lending programs, and to be able to legislate the yields from the assets. But central banks have also provided some subsidized bank lending through cheap long-term financing. And that's very well documented by a number of authors here. And also outside Africa, central banks have been active by designing liquidity provisions for central banks. Central banks lending to banks, which play a key role in the economy, so that they can be able to ignite recovery and resilience. Specifically for COVID-19, there has been the easing of capital buffers, easing the capital buffers of Basel III. Basel III, the new regulatory regime, required tightening of capital buffers. I think this has been eased, and in a paper by Bitt and Tarazi last year, they did highlight 3 ways in which this has been done. by removing the requirement of capital buffers totally or partially, by encouraging temporary ease of capital requirements, and by delinking the use of capital buffers from dividend payments in the US. Now, the reason why we thought we'd highlight this aspect is that some of the central banks in Africa are traveling in the opposite direction, in the sense that about 2 months ago, some of the central banks were tightening on capital requirements, which will mean that some of the banks, some of the smaller banks, may actually be forced to merge or fall out of the financial system altogether. So if we just try to capture some signals, not all the signals, but the key signals from that data, and there's quite a lot of data, some of which are not shared here. The data suggests that many of the central banks in sub-Saharan Africa are really facing serious obstacles, mainly as a combination of the external, but also we should admit some domestic challenges. The external factors that we highlight are the collapse in commodity prices, but also inflation, rising inflation, and exchange rate depreciation that we have captured. We have also noted that central banks' international reserves have been depleted, impacting on the import cover that central banks can be able to provide to sustain imports in the economies, especially for essential imports. We have also seen the signals that there is increasing volatility of capital flows. And there is a huge debate actually among central bankers in terms of the way central banks are reacting to this volatility in capital flows. Some take the hard road of trying to reverse the capital flows by some amount of controls, but some of them in terms of also trying to look both into the key instruments for capital flows, the interest rate and the exchange rate. But this data also identifies some domestic factors. And the domestic factors here really, the key factor has been in terms of the fiscal space, the persistent weakness in government cash flow management, and the fiscal balances deteriorating that we have just seen. In terms of the government budget constraint, the arithmetic of balancing government spending with central bank operations, the limited fiscal space and deterioration in a fiscal balance, this makes it very difficult for central banks to adequately manage liquidity conditions because then they do the financing. And that's a domestic factor that has to be taken into account. In the 6 building blocks, I shall come back to this factor of the domestic factor that are contributing to which have to be taken into account in the design of the financial architecture. It has to be one of the building blocks. But the geopolitics, especially the Ukraine-Russian war, and then the supply chain, disruptions, and it's just look at the structure of African economies. 15 African countries imported over 50% of their wheat products from Russia or Ukraine, and these countries are here named. So it's how this impacts for central banks. It's how this affects the food and fuel consumption. How this impacts the foreign exchange reserves. How the hike in those prices also feed into consumer price index and ultimately imported inflation. Okay. There is also difficulty of energy transitions Especially if you look at the key Africa gas producers, Algeria, Libya, Nigeria. We look at these problems. We look at we've looked at the key challenges, the financial crisis, the indicators. What we read from the data? We need to cast all this into maybe some theoretical underpinning for us to be able to see how we can possibly interpret or design the appropriate responses, interpret these indicators or signals in terms of excellent theory. And the theory that we invoke, that is central banking, revolves around the flow of funds conceptual framework. In the flow of funds framework, central banks facilitate flows between households, banks, firms, the government, and the rest of the economy. It's the efficiency of the central banks that make the financial flows happen on the domestic scene and also globally, rating one economy the rest of the world. Okay. There will be theories built around this conceptual framework. Okay. And these theories have pervaded the operation of central banks. Whether you look in terms of, say, theories on price stability, for example, looking at the demand for assets, by end of these, demand for assets by households, banks, firms, government, and also the world. And these assets in the economy have prices, and so the price discovery of these assets, the interest rates attached to any of these, to relate especially the domestic currency, which is one of the assets held by households and banks and their firms. And then that if the prices are not stable, that generates inflation. But if the foreign prices of these, of currencies, the foreign exchange rates are not stable, then of course there is a problem in the foreign exchange markets. So we can look at it in terms of theories that look into price stability and the role of the central banks in price stability. Actually, it's supposed to be goal number one in theory, that goal number one of the central bank is to manage price stability, control inflation, whether it's by inflation targeting or another means, but the control of inflation becomes important. There are also theories that show about, legislation, risk reduction, and financial stability. So these theories, there's a huge amount of work that looks into financial stability, risk reduction. And here, these issues are looking at the role of central bank supervision and the role of central bank regulation to provide transparency of information for pricing risk involving various financial institutions and financial markets. And so the financial stability theories of financial stability are very heavily tested. And actually, key measurements from simple measures of financial risk to semi-complicated variate risk, and now extensions of variate risk, downward risk, and other types of risk here to actually look at the role of central banks in terms of whether they are able to reduce the risk and through supervision and regulation. There is also, of course, that whether you are looking at price stability or financial stability, there is a peer mechanism, the incentive structures, the incentive compatibility, and incentives for covert regulation. That central banks underpin incentive compatibility for market discipline. Market discipline achieved, say, for example, through peer monitoring in the interbank market. There is also, of course, the other role of central banks on payment systems, especially cross-border payment systems, and say theories that show the efficiency of payment systems, and reducing transaction costs in payment systems. So the argument being that central bank could be able to facilitate and support fast and efficient payments and collection payments nationally, domestically, and also across borders. And this relates, of course, to new work that is happening in Africa. But there is also looking at the theory of central banking in terms of the indirect laws, in terms of the flow of funds, that an efficient flow, central bank playing an efficient role in the flow of funds can reduce information asymmetry, reduce risk, promote financial intermediation, and ultimately lead to economic growth. Okay, and these models that link finance and economic growth in vogue in the literature. So if we look at the main theoretical constructs revolving around the theory of central banking, we could argue that central banks do have a role in actually reducing the virility of these shocks of African economies. And it's on that basis that we shall be taking these theories into account when we are looking at the 6 building blocks for redesigning the architecture of central banking in Africa. Okay, now this is to expand these theories back in financial stability and put in some of the theories in the banking and finance literature, the market failure, which we have just, we started with, systemic instability, which we have cited on, asymmetric information that can easily be, as it, the microprudential regulation, as well as macroprudential surveillance for financial stability, market misconduct supervision, anti-competitive behavior for competition. So basically, this in terms of trying to identify the framework in terms of how central banks operate. But one could also interpret the framework in terms of the regulation and risk. Now, it is interesting to note that for every major financial crisis, going back 25 years ago, that it appears that the design for bank regulation globally has been a way of trying to learn and adapt to the financial crisis that happened. So if you start with the Basel I, came up after the experience with the Asian finance, with the banking crisis that happened before. And then comes the Asian financial crisis. And Basel I had not taken into account some of the challenges in central banking regulation. So after the Asian financial crisis, you get now new work towards Basel II, extending the pillars. But basically, Basel I was straightforward, just a simple capital adequacy, 8%. Okay. Now, of course, what we learned from the global financial crisis, from the Asian financial crisis, was that it is possible for a bank to have a good capital adequacy, but fail because of these other shocks. And then you have the global financial crisis happening, and then you have the transition from Basel II now to Basel III, introducing all this market discipline, the pillars, and now we have the work on liquidity here, global liquidity standards monitoring, and here is the ongoing work with the Desiree Kang at IMF and the East of Somalia, who is in the audience, in terms of the way liquidity becomes an important dimension. But what we see here on the evolving from Basel I, Basel II, Basel III, and the construct of the pillars 1, 2, and 3 is the fact that a bank regulation and Basel is also dynamic, but almost like catching up with some of these shocks. The redesign of financial architecture for African central banks has taken into an account a kind of anticipatory okay, trying to look ahead of the curve, trying to actually be able to predict reasonably well what the next shock might be, and whether we have a system which is adequate to be able to safeguard the African economies. I just include here just this slide taken from the UNDP Regional Bureau for Africa 2021 about the macro effects of COVID-19, and just straightforward in the sense that basically COVID-19 distorted all the macroeconomic indicators. Now, the question that remains unanswered here is how the global, how these external shocks are transmitted to African economies. And in the work with here, this is the work that I highlight here, commodity price shocks with Francois and Isof in 2023, which basically has a question on how the global credit market shocks are transmitted to financial systems in African economies. Now, this work is so much relevant, this discussion here, because it takes into account that some of the transmission channels for international credit shocks have been identified. Some previous work has said, okay, it is housing prices. Some work has said, well, it is exchange rates. Some work has said it is asset prices. All this previous work had omitted one major source of transmission of these shocks to African economies: the commodity price cycles. The commodity price cycles being very important, and what is strange is that, of course, we know the role of international trade in Africa and globally, and so it's very strange that this channel had not been explored in previous work. Okay, but the question again remains that if the commodity price channel is identified as a big channel through which the shock happened, how can central banks mitigate against this channel? How can they be able to safeguard African economies from these shocks, especially those arising from commodity prices? Central bank theory, and that's the reason we reviewed it, points to the role of regulation, especially macroprudential regulation. Could it be the case that macroprudential regulations can be used by African central banks to be able to mitigate the risks associated with these external shocks? And the argument here in another paper by with Francois Botiano and Sof Somare is especially the working paper, which is in the Center for Global Finance, working papers, is about the transmission of global credit market shocks credit cycles in the developing countries. Can macroprudential regulations attenuate the virility of the shocks? And why I think this paper is particularly relevant to this discussion, and given the shocks that have hit the African economies, not only through the 25 years, but recently with COVID-19, is the argument in this paper that what really counts, what really is important, is the selective use of macroprudential tools. That trying to use all the tools without targeting will not work. That what is necessary is to be able to identify, to go look at the individual tools and try to identify the tools that can be able to work for a specific type of shocks. So it is more or less like pinpoint targetry. It is almost tailoring the macroprudential tools to the specific shocks in question. Okay, and I think this is where the paper makes a big point, a big breakthrough. Of course, I just want to highlight some of the aspects in this paper which make that possible. They take a good model. They will look at the model of commodity price transmission, look at the composition of commodity price index, try to pin down the nature of the commodity price shocks. But it is this identification of the macroprudential tools, 17 of them. Okay. Maybe one central bank want to use capital requirements. Maybe one central bank use counter-cyclical capital buffers. Maybe one central banks want to use liquidity limits. Maybe one central banks want to use liquidity reserve requirements. Okay. That may be the argument here is that it depends on which macroprudential tools you use. Or maybe the central banks want to combine a number of these tools. Maybe capital requirements plus limit on leverage leverage of banks, okay, to be able to address, for example, the lack of liquidity or the lack of FDI inflows for a number of years. Or maybe wants to use taxes and levies as a transaction cost, okay, to either increase or reduce some type of capital flows. Or it wants to use reserve requirements to be able to give banks liquidity, to be able to kickstart, to finance the real sector out of a depression. So it is that argument in the paper that becomes particularly important in this argument. And so what you have here is that in that paper, the number of indices. So you have a number of where you get a number of instruments, tools together to address credit cycles. Okay. Where you have a number of tools together to address the foreign position of the bank, the borrowing positions, or the bank stability to increase bank stability in the country. I will summarize a bit of the evidence. The evidence from that paper shows that there is a positive effect of cross-border banking capital flows on credit cycles. This is consistent with the literature, okay? That basically most of these shocks happen through the participation of the banking sector. Okay? But it is the interesting part, the new part, is to suggest that commodity price cycles of all the transmission channels identified in the literature, it is the commodity price channel that is important in being able to transmitting these global shocks to most of the emerging markets. And how about in terms of the tools, selection of the tools? The new evidence in this paper identifies particular prudential regulation tools which are efficient. First, the tool that can dampen the credit cycle, okay, which means that the economy, the central banks can be able to stabilize the economy rapidly by using certain regulatory tools. The tool that target foreign exchange reserves for foreign exchange exposure, which means that the central bank can be able to stabilize the foreign exchange exposure and the foreign exchange rates and the tendency towards their depreciation. Or the tool that can actually safeguard the safety of financial institutions by enhancing institutional capacity or bank liquidity, again, as mentioned in that paper. So that's what we, at this juncture, I don't know how I'm doing for time, but I guess I should be able to summarize quickly where we are. Okay, let me now come to the final bit of this. By the way, you feel free to post any question in the chat or to raise your hand if you get any question or a line of intervention. Okay, so now, in view of the fact that we have summarized the shocks that have hit African economies for the last 25 years, including the recent shock that arises from the COVID-19 lockdown and geopolitics, including, given that we have identified the economic indicators to show the distortion in the economies in Africa, we have also invoked a central bank theory to show how central banks may respond. We have also borrowed from the work with Issouf and Francois and Desiree Kanga in terms of showing that a macroprudential regulation can actually be able to fix the impact of these shocks on African economies. Given also the knowledge that we've seen how central banks globally have responded to previous shocks and so to COVID, the question now is, in the conclusion, what is the way forward for African central banks? Yes, it is shown here that macroprudential regulations can play an important role. But beyond this macroprudential regulation, what is the way forward? The proposal here, one of the suggested ways that one proposal would be to actually look into redesigning the architecture for financial resilience in African economies. That it's not business as usual. And given that the international bank regulation, especially the BIS, the Basel rules, adaptive of the shocks that take place, how should African central banks redesign themselves to be able to deal with some of these shocks? There are many ways of going around this, but here we identify 6 building blocks which have been taken into account in the redesign. The first is relatively new, which is the Pan-African banks on the rise. And this is showing how the recent rise of indigenous banks in Africa are, in a way, influencing the way commercial banking is done on the continent. And maybe this needs to be taken much into account because that has permitted a higher degree, in just less than 20 years, has permitted a higher degree of cross-border banking than what has happened in the last 50 years. So it's not so. We're going to talk about these building blocks of Pan-African banks and the role they play. The second building block is the role of the interbank market. And here in the Center for Global Finance, we started on the seminal papers. Previous to our work, there was no work on the interbank market in Africa. We started with Kenya, then included Zambia, included Uganda, included Malawi. And the insight from all this work is to show that there is a need for bringing in, looking into the incentive structure of how players, bank players in the interbank market behave. And so in a way of building peer-to-peer trust. The third building block is to go back into the question of central bank independence. And this draws actually from the work with the Patrick Njoroge and Desiree Kanga Patrick Njoroge, the former governor of Central Bank of Kenya, and Zikanga now at IMF, in terms of measuring, looking into design of new measures of central bank independence, and comparing, taking broader aspects of the governance structure and how this maybe gives much more room for central banks to be able to deal with external shocks. And the fourth building block is the role of FinTech, the FinTech revolution. And the fifth block is on the roles that African central banks are playing now, or have started to play, or become aware, as in the meeting in Livingston, of their role of African central banks in climate risk mitigation. And finally, the prospects for regional monetary integration choice. As time tends to infinity, one Africa, one money. Okay, so these are the 6 building blocks. I just highlight a couple of these in the interest of time. Maybe I should be finishing in about 10 minutes. Let me highlight each of these building blocks. First of all, this is supposed to build all the building blocks together. I skip this. So I'll start with the first building block, the Pan-African banks on the rise. And actually, some of the work with colleagues here in the network has been able to actually pin down the new wave of Pan-African banks. And also, this is consistent with the African Continental Free Trade Area strategy for intra-African trade in financial services. But the new evidence is very clear. With a paper by Desiree Kang and Yusuf Somare here in the audience, that this has enhanced bank stability. But they also, with the an area paper with the Desiree and Yusuf, that increased presence of Pan-African banks have increased competition in the credit market. And with another paper with the Desiree, Yusuf and Lemasenbet, says Pan-African banks have increased, they have driven financial inclusion by medium and small enterprises. And another paper with Desiree and Yusuf that these Pan-African banks are supporting enhanced bank liquidity. So you can see that these Pan-African banks have to be taken into account in the design of this. So they form a building block, a big building block, an important building block. Okay. The second building block is the role of the interbank market. Why? Because as stated in the recent book last year with the Patrick Njoroge and myself, we said the future of bank regulation cannot ignore peer-to-peer trust, cannot ignore monitoring and market discipline. And that includes a number of studies done here in the Center for Global Finance, the research on Kenya led by Tiliongo, on Malawi by Kanyumba, especially her recent PhD at Lafobra, on Uganda by Thomas Bwire and Martin Brownbridge, on Zambia by Jonathan Chipiri and group. All this work uncovers a stable inverse relationship between interbank activity and bank risk levels. So it becomes a very important aspect, a very important wheel. But actually that has also been recognized in some of the previous work, recent work, that financial regulators can rely on a number of us, the role of the interbank market in a paper, recent paper this year by Chris and Yi by on how the interbank market plays an important role. It's definitely building block number 2, or building peer-to-peer trust. The third building block is the role of central bank independence in redesigning the architecture of financial resilience. And this draws in a chapter, a paper that later became a chapter by Patrick, Desiree, and myself on identifying what element of central bank independence works better? Is it goal autonomy? Is it target economy, instrument economy, or limited economy? This is quantified, and we're able to match the role of central bank independence in all these in all its forms. In all its forms, it's a critical component. But perhaps personal independence is very important. And in the design of the board of directors, of the governance, the directors, the central bank governors can actually play an important role. But also the board is equally important. Now, the other building block for designing the architecture for financial resilience is to include financial inclusion, especially through the financial technology. And this is a big agenda, an agenda we are already back to. Financial inclusion matters for central banking. John Rwangoma, the governor of Central Bank of Rwanda, made that very clear in a paper in 2021. But also you have these waves of new technologies, flatware Nigeria, payback Nigeria, Serant Kenya, and others. The whole argument is that technology will play an important role. And even when we map down, this is on work with the FTMOS and their colleagues in terms of what type of financial technology is in vogue in each of the countries in Africa, also including sandboxes for regulation, also for payment systems, and the big question, is there a role for central bank digital currency in redesigning the architecture for financial resilience in Africa? We think yes. We show in this map which countries have already, those have launched, those are piloting, those are thinking of development, those are thinking of research, those which are inactive, and those have even canceled the project, which is updated from about 2 months ago in terms of, but the whole picture shows, yes, there is a drive for central bank digital currency. And there's a lot of debate, but it's an issue to be explored and possibly to be integrated as a very big building block for central banks, for some of the reasons that are summarized here. Another building block, number 5, is the role of climate risk mitigation. And that's mainly because, if I can summarize it possibly in less than 2 minutes, it's just integrating the physical risks of climate risk, the transition risk, and in work with the Uli in economics and Gerhard Hing at Aberdeen, it's been shown that many developing countries, especially African economies, do face disastrous lending rates because of climate risk. And this is where central banks are exposed. Okay. And that this is the paper here, the impact of climate vulnerability on firms' cost of capital and access to finance in world development 3 years ago. And that really shows that basically central banks have to play a role in especially climate risk mitigating, and of course, in generating climate finance. Now, here, this slide is not about climate thermal images. It is, on the contrary, about one Africa, one money, or at least African region, one money. The regional monetary integration choice as a building block. This is what actually take each of the from the paper by Funkeman and Bessa this year, was take each one of these building blocks and show whether it is possible a great benefit that the central banks in each region are together, so that we have possibly 5 regional blocks of 5 central banks covering 5 regions, gravitating as time tends to infinity to one central bank in Africa, maybe as time goes on. However, this work did reach a conclusion that maybe it's something that it needs to wait a little bit. However, in ongoing work with Athina and Eric Jardine at Aix-Marseille University, we look at the underpinnings for, say, for a common currency in East Africa. We first look at inflation. say in this case, by number of countries, and we find that only the outliers may be Burundi and South Sudan. We look also in terms of the GDP inflation, GDP deflator. We look at it in terms of the nominal deposit interest rates. We look also in terms of debt service. We also do in terms of growth, in terms of foreign exchange reserve. And on that basis, we design a synthetic East African currency. We are convinced on the basis of synthetic East African currency that actually it can be stable. Okay. We change the weights, and the weights are designed on the GDP, but it can be stable for these countries, especially that it can be stable initially if we take a wave of the Eastern African region, initially taking about 3 or 4 countries. You find that the synthetic currency outperforms all the national currencies. Okay, so there is a scope for some amount of regional integration as a reform of central banks. Okay, so the regional integration choice, we'll say it works. Africa has a stark choice, either respond together or not at all. Okay, and we also invoke some game theory, set prisoners dilemma. They have to act together to be able to survive. And we look at a number of motor shocks, and we then compare, we take a quasi-experimental approach, look at the multiple shocks around the COVID area to be able to stress test the balance sheet of central banks and associated flow of funds. And then we're able to work the average treatment effects, and we find that actually, if they responded together with one synthetic currency, they would emerge much better and be able to withstand some of these shocks, a number of these shocks. Okay, that's where we are. It was a matter of sharing just these ideas to provoke discussion. I'm sorry I've taken so long, but yes, now I can wait for a comments question. Thank you. Okay. Okay. I can see a number of hands up. Okay. Okay. The first hand, George, yes. George from the African Development Bank. George, yes, please go ahead, and then, yeah.
Hi, Victor. Thank you very much. So, I mean, from the ADB perspective, I think this is an interesting contribution. I think if I were to summarize your thesis when you are seated there, is that we need to understand that the financial sector will remain a critical component of building resilience in Africa. And there are a number of areas which we still need to think about. And you kind of suggest them, issues around integration, for example, including strengthening logistics to enhance trade, issues around building capabilities. For example, in the context of COVID, one of our big problems was that we couldn't produce the medication that was required immediately and control the impact of the disease, so to speak. And so there's a number of areas where we need to take action, and the financial sector is just one element. So my conclusion from what you're saying is that, yes, the central banking system needs to be revisited, but revisited in line with other reforms in other areas of the economy. And one transmission mechanism that you actually concluded with is actually the risk premium. I think risk as a transmission mechanism, perception of risk as a transmission mechanism is not, you were explicit. You guys don't spend a lot of time exploring that. But in terms of the transmission mechanism, I think the ADB in 2020, in the Africa Economic Outlook, actually spent a lot of time to try to discuss some of the transmission mechanism of shocks on African economies, including, transmission through trade, which I think you call it commodity price shocks, the mechanism. There was also a lot of discussion around skills as an element, because what COVID did was that when people are now stopped from moving around and some people started dying, particularly nurses and so on, it was clear that the burden, for example, in education and health became quite dramatic. And so my point is that maybe this work needs to be also done in collaboration with other specialism to interrogate, for example, should central banks now start also getting involved in quasi-fiscal measures, for example? And the answer to that may be not, because there are other agencies who could do a better job, but in synergy with the central bank. So that's really my comment.
Yeah. Thank you very much, George. I agree with observation. Central banks on their own, quite clearly, cannot achieve the complete stability of economies. But the argument here is that they're a key player. Okay, they're a key player. And if you look at the question in terms of what could be achieved through the theoretical understanding of what central banks play, I think they need to, they could be lead players in this. Now, this argument, of course, does not address the supply side of some of these shocks, does not address the fact that in the economy, you have firms operating, in the economy, you have governments operating. So in the flow of funds is driving this argument because in the flow of funds, the central bank is at the fulcrum. It's actually playing whatever happens in the economies is the way the efficiency and the availability of liquidity is being programmed central bank. That doesn't mean that other contributors don't have to play a role. Yeah, so it is. This is the way it is captured. And now, if we are working, if this question had to be addressed by an institution like the African Development Bank, then you would of course have to have other players on the table, and each one being recognized what should be. Also, the question would slightly change, say how can central banks play a role to the extent that other players also have been able to take their leverage to be able to, yeah. How can other players leverage on the role that central banks play? Yeah. Okay. Bo, I'll take Bo, then Chase, then Andy, then Dak, and then Slide. So if you could be brief, and then we can be able to, yeah.
Yeah, so on this topic, I just wanted to recommend a forthcoming article in Economic Letters by Rashad Ahmed and Joshua Eisenman and two other guys on the effectiveness of foreign exchange reserves during the 21-22 US monetary tightening cycle. So what they show there is that you have, say, 10% higher reserves than others, you can avoid a depreciation of currency by 1-2%. And that effect is also much stronger for poorly developed financial markets. So I think we had a similar story during the 2008 crisis, that countries with high reserves did much better. So the general advice is for African central banks, have high reserves because you might actually need it one day.
Exactly. Yeah.
I can send you the link.
Thank you so much. Thank you so much, Bo. That's very, very, very timely. Yes, indeed. And it does. We'll then re-emphasize that when we look at the 17 instruments for macroprudential regulation, that foreign exchange reserve instrument is very, very important. And thanks for the paper. I was not aware of it, and we'll definitely acknowledge it. Thank you. Chase. Chase Foster, for those who are here, is our new colleague, member of staff in the School of Finance and Management at SOAS. Please go ahead.
Hi, great. So I just this was a really nice overview of kind of all the different moving parts, in the kind of African central bank landscape, and it was really informative for me. So I know the focus is macro, but I'm wondering, do you think there's any role for sort of smaller community embedded cooperative financing. I mean, here in Europe, of course, we have state banks, we have cooperative banks that, and I'm wondering if sort of encouraging heterogeneity of finance could actually be another way to maintain stability in the face of unpredictable shocks. And then my second very quick question is, are you at all concerned that the aspiration toward currency union could actually create financial instability of its own kind, right, and reduce countries' ability to respond to shifting conditions? I mean, of course, we have the euro crisis here, which in some ways arguably made it more difficult for countries in Southern Europe to take appropriate central bank measures. Thank you.
Yeah, thank you very much, Chase. Yes, the micro elements are trying to look at the diversity within the banking and finance system is very important. I do take that comment seriously because we here invoking the theory of banking, which basically looks at commercial banks. There are many financial institutions in the economy, and especially in Africa, which are not under the oversight of the central bank. Non-bank financial intermediaries are not under the oversight of the central bank. So that's a very important point, in the sense that they could actually be the shocks could be hitting these economies, these micro financial institutions, including microfinance operators. So if they are wiped out, definitely the contagion will spread the rest of the economy. So that's a very good argument that there should be a broader oversight over this to have. And in fact, Africa is marked by a high degree of non-diversity of financial institutions. Most of the economies have the same type of, commercial banks and so forth. So when you look at some of much more specialized institutions, including almost absence of wholesale banks, for example, something that is common in that. So that's a very good, thank you very much for that. Yes, currency unions, yeah. This, I think that's why we say that we start with the a game theory. In this work we are developing with Eric Jardine and Athina, we have started with a game theory aspect that, basically we are all in it. But like in the game theory, in the prisoner's dilemma, it could cut two ways. Okay, it's cut two ways. It may be that will be a source of, contagion and fostering risk. Or it could be a way of redeeming the economies. I think our work should acknowledge the dichotomy of the potential results. Yeah, thank you. Andy and then Dak and who was for Bojo is no, so Andy, Dak and then Solite. Yeah.
Okay, well, I'm going to continue a little bit on the theme of currency unions, actually. So, I mean, I very much agree with what Chase has just said. I mean, a currency union can help, but also may not help. Currency unions between relatively small numbers of relatively homogeneous countries might be beneficial. Currency unions between large numbers in the whole of Africa, very heterogeneous, might not be helpful. But also, I mean, Africa currency unions are a very long way away. I mean, if countries are not able to make significant progress on trade integration, it's very hard to see how you're going to get to a currency union. Now, I think you're exactly right to focus on East Africa, because that's the region that has made most progress on trade integration, and that's the region that I think has the best prospects for currency union. But a currency union for a larger number of groups of countries than that, or for the whole of Africa, I think is a very long way away. Africa's making such slow and tentative progress with AFCFTA that an Africa-wide currency unions, I don't think I'll see it in my lifetime. Thank you.
You're absolutely right, and I think the feeling is mutual here that this dream of one Africa, one money might be something a long-term horizon to look at. But in terms of how this can be achieved, it's tricky. The observation you made about the East Africa, yes and no. Yes, it's a very good example, I think, among the regions. But also bear in mind that the West Africa BSSO, they have already their own currency, initially based on the French franc, and also the East African, the Central African Central Bank is one. The West African Central Bank has eight countries, the WAIM countries, and that seems to be a little bit homogeneous. So you could say that among the blocks in Africa, the West Africa, one currency, Central Africa, one currency, but now they are more or less operating on the euro. The East African, the work that we are doing on the East African countries, the synthetic currency that we are playing around with, mind you, we have only now used the weights of GDP weights, actually agricultural output weight. I think we need also to try to use the assets of the weights to be weighted by assets of commercial banks or assets of financial institutions as one of the possible, because there is no strong capital markets that we could use the index of the capital markets, so would be the assets. But the preliminary results show that out of, say, Kenya, Tanzania, Uganda, Rwanda, you get stable results. The synthetic currency actually performs much better than the four countries. The snake remains in the tunnel, the snake being the new currency, okay? But when you include Burundi and South Sudan, then you get different results, okay? So even then, I think they'll still have questions to be addressed. But thank you very much for these two observations. Yeah, absolutely. Dark and then Solite Tumine. Dark.
Yeah, good afternoon, Victor. Good to see you. What a wonderful lecture, and also it's been an honor to follow Andy's comments on the ACFTA. I have two questions that I'd like to have your view on. So the title is sort of on central banks, right? Responding to crises, and there's a narrative with some parts of the community that say central banks were too late to respond to the latest inflationary spiral, and also that inflation is more persistent than we thought it was initially, at least in the UK. And that has also permeated some of the research communities that work on the real sector in Africa. And so I want to have your view a bit, sort of, what do you think central banks, and if so, which countries, maybe some examples, have responded in the right way, in the right time? Have they been too fast? Have they been too lenient? Or so have they been too slow, basically, to respond to crisis? And I think I remember sitting with you in a room in Nairobi 15 years ago or so, or 12 years ago, with the global financial crisis, when I think at least my conclusion at that time was that there was previously sort of the macro policies were slow to respond, that at least many African countries had learned to be much faster. So the question is a bit sort of, are they fast enough now? And is there a problem or not to address? And then, of course, you can talk about tools. Secondly, the question is a bit about tools and targeting. So I quite like your argument on targeting, so middle through the lecture. And when we looked at some of the responses of central banks in 2020 to the COVID crisis, we saw that some central banks are horizontal and some are more vertical, right? So they're monetary easing perhaps around certain sectors. So my question is a bit sort of, do you think that is useful, that central banks do that they are targeting So you can think about instruments, but that also targeting certain sectors. Maybe also some unemployment-rich sectors. Some maybe they can even have gender objectives or climate change objectives as well. So do you think there should be more targeting for central banks? And particularly due to crisis, so that you want, when you come out of a crisis, you want to come out of it in a slightly different way than you come into it, and that you then target specific activities that are perhaps more inclusive, more transformative, and greener. So I'm wondering what you think about that, whether that fits in your comment on targeting, or what do you think it should be sort of horizontal, stay horizontal?
Yeah, thanks very much, Doug. As always, a very constructive input and observations. Yeah, your first question or comment was about central banks' response to the inflation spiral. By the way, the central banks, at least globally, responded in two ways. Immediately after the COVID-19 and lockdown, some central banks, together with their governments, responded in the design of special packages to assist companies, organizations, and even some individuals to be able to weather the COVID-19, especially the lockdown. And you can see that in those packages, governments were designing some quantitative easing to be able to put together special packages. The African countries were hiring consultants left and right to be able to design some of those packages. So I think that was the right response on what packages can be put together. Ultimately, it's not clear which one of the 54 African countries were able to implement those packages, and actually not only in Africa, actually also globally and even within the UK, whether the funds actually ultimately were flowing to the right companies, especially the small sectors. But that was a good response. But they also, in terms of responding to inflation, which is the concern number one, at least in the theory of the central bank, yes, I think almost all the central banks, as we show on one of the slides, responded by hiking interest rates. We only saw at least one country which didn't respond in that way, and my guess is why. Okay, I did, and maybe because of the foreign exchange reserves that country has, but many central banks responded. The question to me in terms of central banks responding to especially the inflation spiral is how effective they have been. In other words, you have had increases upon increases upon, but while inflation is actually building up. My argument is there was something missing. Okay. Because there was part of the inflation that is driven by money, and especially quantitative easing money, and especially by liquidity. Okay, but there is also part of the inflation that has been driven by the supply side. Okay, in my theoretical modeling of inflation, okay, I combine basically the aggregate demand, the production function, and the labor market. So from the production and labor market, I get the aggregate supply. So inflation is determined predominantly on the supply side. Okay. Now, this has not been integrated into the way central banks have responded. It's as if you responded by interest rate hiking, you can actually, bring down the fire. But how about addressing the supply side? And I think that's the bit that has been missing on the supply side kind of response, because with the supply chains were all broken globally and especially in Africa. Okay. not enough commodities. Shops are still closed and companies run bankrupt. And so all that is still restructuring, by the way. Those effects are still with us, even when you walk around London, as you around the center, including, yeah. So that supply side is not captured, but central banks, I think, have done their bit. In terms of the tools and targeting, other sectors, yes, I agree. There has to be some amount of targeting, indeed, for the supply side. But that really should not be done by central banks. Okay, I think that central banks has to work with other players that can do the targeting of the especially of the supply side and interventions. I know some central banks have, both in industrial and in developing countries, put together special programs, for example, to assist small and medium enterprises. Some of the programs which are gender-driven, some others as special programs. That is creating like a fund. Okay, that can do that. But in particular, they couldn't do that without involving the targeting of supply sector players. This is what I think. Okay, let's bring in Professor Solai Tumine from Makerere University Business School.
Thank you so much, Professor Murinde, for the nice presentation and other participants on board. Mine is just one thing you ended with or ended at, advocating for one currency across East African countries and others. And my viewpoint is, yes, if that is advocated for, maybe how can you shed light if it is advocated for and it so does happen, how would it play a role in raising liquidity for central banks, which normally face a problem? That aside, we know that central banks' role is majorly regulatory. If their work is regulatory, how can liquidity, which many of these commercial banks and central banks face, be raised by a regulatory arm of government as central bank? Maybe you can now expand on that one. Then thirdly, how do you think the liquidity preference theory by Keynes would be of importance to the study that you are conducting or you are about to conclude? And lastly, in liquidity as an aspect which is part of the enhancing resilience, it is more to do with micro than macro. And what would be your take? How would you descend from micro to macro, especially in the aspect of liquidity, which is a key aspect affecting central bank as well as commercial banks? Thank you so much.
Yeah, thank you very much, Slide, for these 4 important observations. The question of liquidity is very important, Slide here. And if we had one East Africa, one central bank, liquidity issues would be balanced, across the region. And the revenues from the currency issuing, the signage would be, of course, distributed across the region. But this is the East African Central Bank would have more power than the individual central banks we have at the moment to be able to enhance liquidity. Okay, they would have more power to be able to enhance liquidity, to be able to mobilize funds, and to be able even to mobilize funds using the traditional instruments that central banks can use to mobilize funds both domestically and also externally, to support not only the operations, but also to support governments of the East African region. So that should be actually liquidity enhancement. In terms of the regulatory, actually, that would be like one single regulatory space across the region. Okay. So, and that would mean that the level playing field across the East African region would allow traders, would allow say trading services. Okay, doctors from one region trading in another country and operating within the same currency to work. So the trading financial services, the trading services would be enhanced from that region. So the regulation will not become a problem as long as the rules of regulation are transparent across the main players. In fact, I think that the discussion for the East African Central Bank have been done taking into account some of these liquidity and regulatory challenges. I wouldn't think there would be a big problem there. Now, in terms of the liquidity preference, the Keynes liquidity preference theory is particularly important in terms of why individuals hold assets, why they hold money. It's a way being overtaken by two things, that we are now not thinking more in terms of the holding money, but holding different assets and therefore substituting among the assets. So you hold currency in your pocket, but you also hold bank deposits. You also hold bank loans. You also hold shares in a company. Or maybe you have also been able to buy some treasury bonds from Bank of Uganda or for government from the central bank, issued by government from the central bank. So you have a portfolio. Okay. Money is just one asset. When you have a combination of assets, you have a portfolio. And your own now is in terms of that portfolio. Now, some of those are liquid, but now the tendency to actually go for more liquidity, more money is less. Why? Because of financial technologies. Financial technologies are making it much possible that I really don't have to hold any money in my pocket, in the sense that the FinTech values the FinTech or the credit card you have or the M-Pesa you have on your phone. I don't know whether you transact money with the you transact with cash in the capital city, or whether you are able actually to use your phone and make payments and transfer even up to your rural using just the technology of your phone, which is FinTech. Okay, so that has been adjusted by the changes in time. In terms of enhancing resiliency, I think yes. I think the East African Central Banks, in a way, that's why we are putting it as one of the building blocks, that it would eventually enhance resilience, the ability to respond to some of those shocks timely and decisively. Yeah. We have Dr. Petropoulou, University of Nairobi.
Thank you. And thank you for the very interesting presentation. I like your response on the vulnerable funds vis-a-vis the Keynes liquidity preference, which has a big limitation in the wake of financial innovations. Now, my interest in the contemporary central banking is with regard to the growth of the Pan-African banks and the SIGO East Africa Central Bank. It's quite interesting that the Pan-African banks don't seem to be doing well relative to the 5 top commercial banks in Kenya. And what do you foresee to be the challenges of the SIGO East Africa Central Bank relative to the rapid growth of the Pan-African banks? Thank you.
Yeah. This is thank you for that important observation. If you take the African landscape, the Pan-African banks have hubs in Nairobi, in Kenya, in South Africa, in Morocco, in Togo, and in Nigeria, and they seem to be performing well. But it may well be the case that in Kenya, the performance is not as good as we would expect elsewhere. But I think that again is not a permanent issue. This may happen because of a number of changes. But in general, the evidence we have and which I shared with you is pointing to the fact that the Pan-African banks are really enhancing a number of factors, and it's a conclusion that supports the role of Pan-African banks in Africa. I think one could do a case study of some of the banks, because the devil may be in the details, or the devil might be in the details, which could then identify, that's a study that Dr. Petropoulou could do, which would identify conditions under which the Pan-African banks are really making a difference, or conditions under which the Pan-African banks are facing some obstacles. And that would be possibly intuitive. Yeah, that might be helpful. I was not aware of the challenges in that case. That's why I put it that way. So, no hand up. I think we also are running out of time, 4 minutes to the end. Let me thank you so much for your participation in this seminar. I know some people are traveling now to other meetings, and I thank you very much for being able to get the time to do this, to be with us, and also invite you to the session next week, same time, and we shall be, as usual, getting in touch with you to arrange that meeting. And for those meetings that will be on campus in London, we shall again be inviting you in campus to be able to share a fellowship with you over and above the meetings. Thank you very much. And I hope this will provoke some future work, collaboration, and this is a discourse that we need to get going. Thank you very much. Okay. Bye-bye.